Got data out of Germany this morning that is bleak. It fits a picture of bleak data that has been coming out over the last few days. How much does this undermine the kind of long Europe case that so many people have got built into their portfolios?
It certainly weakens it. I guess the question is, if you don't go long Europe,
yep,
almost where do you go? Because
right.
the world as a whole is pretty challenged. The US data suggests that the US economy is at best slowing sharply, potentially heading down towards a recession. Europe, at least things are still moving forward very slowly, but absolutely the easy lazy trade of long Europe is being hit quite hard by what we're seeing out of Germany.
How much of what is built into that trade is an expectation of further QE?
Probably quite a bit of it, because in a sense markets have seen what QE did to stock market levels in the US, and if we look at the unemployment data, inflation data in Europe, there's still probably scope for Mr. Draghi to do more.
Yep.
And as a result of that, the kind of learned behaviour from the US experience is when a central bank ramps up money printing, that tends to mean stock prices go up, and so I think we will probably see more QE from Mr. Draghi, but probably not before next year.
So you'd carry on buying dips. Any dips are an opportunity to get further in?
I think it's important now. It's very much be selective. Look at the fundamentals of the businesses you're buying, and try and understand how resilient is this to an economic slowdown in America, out in Asia, and so on. So yes, that more QE may be coming. That doesn't mean that I know, let's pick on Volkswagen. Volkswagen is necessarily a good buy down here, even if we get QE, because of the stock-specific problems that they've got. So it's important for investors actually to do the homework, look at the individual names, and not simply go, let's buy an index.
A lot of European fund managers are outperforming their benchmark at the moment, and that tells me they're probably light on energy, because energy's been one of the really big underperformers. Oil has bounced quite significantly over the last few days. If they start chasing that to match the benchmark, what is the possibility of a short squeeze around, kind of a squeeze around that sort of space? Not a short squeeze, the opposite of a short squeeze. As we see a catch-up, how set up are we for a squeeze here?
Potentially quite a bit, because as you say, the average fund manager positioning has been is underweight energy, underweight basic materials, underweight of the oil services names. But I think if we see that, it will be a short-term pain trade. Yeah. Because the fundamentals are still pretty negative. We're seeing GDP growth slowing down globally. There's no particular sign yet from OPEC that they want to cut supply. US supply is maybe rolling over, but still quite slowly. Yep. And so oil prices likely to remain weak, and that's very bad news, certainly for all the oil service companies that are relying on capex budgets from the oil majors, because the oil majors are slashing capex on a daily basis at the moment.
We'll leave it there. Andy, thank you very much indeed. Andy Lynch, European Equities Fund Manager at Schroders.